Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. This is Quincy Krosby. It is Monday morning. It's October 24th, and this is The Talking Point. Thank you so much for joining me this morning. Let me go back, if I may, to Friday, that monster rally. And why was it important, and how did it happen? Well, first of all, what happened was that the Wall Street Journal had a story that the Fed was going to debate at the November meeting. This is the one coming over on November 2nd. And they were going to debate after that rate hike, which, by the way, the market is expecting right now to be 75 basis points. That then at the meeting itself, they were going to debate the pace of the rate hikes after that, for the December meeting, for example. And not just the pace of it, but, how high the rate hike should be. Maybe they should transition to a slower, less aggressive campaign. We're not calling it a pivot. That is to say that the Fed just stops completely. No, but that basically, after this front loading that we have seen, that is to say, coming in early, after they were late to the game, by the way, and just loading up with one rate hike after another, fairly aggressively, that then they would just bring the pace down. Of course they're going to discuss this, but the article made it seem as though that this was a new thing, that suddenly it's going to be a tug of war between the doves and the hawks at the Fed. Of course, I think they've been discussing it all along, but I do want to say this. We have seen the vice chair at the Fed, Lael Brainard, mention in a couple of her speeches recently that while she wants to be aggressive on tamping down inflationary pressures, she is also mindful of some of the issues that the higher rates, the stronger dollar, can create in terms of financial conditions tightening too much, not just here in the U.S., but globally. So that's one thing. Second, Mary Daly, the head of the San Francisco Fed, who was considered to be in the dovish camp, nonetheless has been a staunch supporter of this rate hike campaign. That is to say, we have to be aggressive. We can't stop until we see that inflation has come down in a material way. She has now actually did a little bit of a transition saying, maybe we do need to see and be concerned about the financial conditions tightening too much with this rate hike campaign, aggressive rate hike campaign. I thought that was extremely interesting. Nonetheless, on Friday, what the market saw across the board moving higher, across the board, almost by the same amount, telling you that it was algorithmically generated, but also that managers were coming in and just putting money in at the same rate across the board. So there you are. Again, the dollar eased. We saw the 10-year Treasury yield come down, and the all-important 2-year Treasury yield, which, by the way, to repeat, happens to monitor where the Fed is headed. And so when we see that yield come down, it is the Treasury market's way of saying maybe, just maybe, yes, the Fed may just not pause, but the rhetoric eases a bit and the amount of the rate hike comes down a bit. So that is what we saw today. You could see the market trying to build on this, although I see the NASDAQ is selling off. Let me go over a couple of things that I did mention last week too. One is American Express. American Express is a bellwether for business spending for higher net worth, middle to higher net worth cardholders. They were given a sell recommendation by Citibank. You don't usually see these sell recommendations. If you think about it, it will come if a company has a terrible guidance, if their earnings disappoint dramatically, and then analysts will come out and then, offer a sell. But usually not before. Now, remember, the analyst who put that sell recommendation out there, said this is because we see a recession coming, and then we see American Express suffering with business spending coming down, business travel coming down, and even the mid to higher income folks curtailing their expenses and spending. Actually, American Express stuck to their guidance. They stuck to a full year guidance. So I just want to point that out of this, recession fears climbing in the market, and again hitting a company that came out and basically said, you know what, we're staying with our full year guidance. And we are seeing spending picking up, although delinquencies have picked up also. But nonetheless, they see the spending not becoming stronger, but certainly not collapsing. Also, I mentioned Winnebago. Why do I talk about Winnebago? Because what we have seen over the last number of cycles is that the campers have led, to the downside and to the upside. And Winnebago came out and said, we're still seeing sales. They're okay. People are still, retiring and they're going camping and so on. I know it sounds odd, but I found it fascinating during the last time that we sold off dramatically, even in the big 2007, 2009 collapse, that not just Winnebagos, but campers actually started to pull up. And I remember looking at that and saying, this is a green shoot. This is a green shoot. This is something that we have to keep our eye on. This is a monster week for earnings. I can't go over all of them because we have a huge portion of the S&P reporting this week. But what we're going to be paying attention to happens to be those big names in tech. Why? Because on a weighted basis, they will together represent about 20% of the S&P 500. So we want to hear what they have to say. What is their guidance? Because one, they have to deal with a stronger U.S. dollar. Most of the big tech names have a global footprint, an absolutely strong global footprint. Apple, right? Microsoft. We want to hear what they have to say. Second, and that is to say, are the yields low enough, right? Which they're not, but do they see the yields coming down on the 10-year to the point where it will help underpin the tech names? You know why the tech names don't do well when the yields start climbing? Because they are long duration. In other words, we take a look at when their earnings come in over a longer period of time. And so when the yields climb, you start to see the sell-off. When the yields pull back, you start to see the tech names get a bid. There's interest. But the question really is, was it enough from the story that we heard in the Wall Street Journal to say that the Fed is finished? Well, clearly not. Clearly not. As long as the Fed this week sees that inflation doesn't break enough and quickly enough, the Fed may have to say, we're going to discuss where we're headed, but we may have to be, as strong as possible in the month of December. So what we're seeing today, and I want to point this out, it's one of the reasons this call is going to be a little bit late today. I wanted to see a report coming out on the PMIs, the Purchasing Manager Indexes. This was this morning, and it was the not the one that we watch all the time, the Institute for Supply Management, the ISM. This was S&P Global, right? There are two different groups doing these Purchasing Manager Indexes. But here's the point. What we saw was a statement coming out of them in terms of manufacturing, that they are seeing inflation easing, yes, in the manufacturing process. I thought that was extremely interesting, and obviously we're going to see if it matches with what we hear from the Institute for Supply Management. But overall, this week, over 100 names coming out, but I'm paying attention to, above all else, to the big handful of tech stocks. I want to hear what they have to say and the market's reaction. Again, about currencies, about rates being higher, and overall about demand, global demand. And then what we are looking for in terms of the data releases, obviously at the end of the week we're going to have the Fed's inflation data release. That is the Personal Consumption Expenditures Index. That index tends to run a bit cooler than the Consumer Price Index. We'll see if it continues to run cooler, but if it does, by how much? Because this is what the Fed is watching. They're watching to see, where is inflation? Has it gotten worse? Has it gotten better? And if it's gotten better, by how much? So that's at the end of the week. Also, the Employment Cost Index, the ECI. Why is that important? Because it is about wages. And remember, the Fed wants to see wages level off, which they are to some degree, and then come down. Why? Because they don't want companies passing along higher prices to the consumer, because that just feeds inflation. So that's the Employment Cost Index, the ECI. In addition to all of this, we are paying very close attention to any of the reports on inflation, because what we're seeing is that the consumers, which had pushed back on seeing inflation rise too much over the next couple of years, that number is starting to rise again, that they're seeing more inflation. The Fed does not want to see the average consumer seeing that inflation is going to rise in any material way. And the reason for that is that once we all start saying, oh my gosh, inflation just keeps rising, we tend to hoard. And it becomes a self-fulfilling prophecy. Buy it today before it becomes more expensive. And by the way, that's the opposite of deflation. On deflation, it's, hey, wait, the condo is going to be cheaper down the road. Everything is going to be cheaper. And so we are in this position right now where what is the Fed going to say at its November 2nd meeting? The market right now is saying that it believes that we are going to have a 75 basis point rate hike. But please remember, it is about what the statement says, and at the press conference, what does Powell say? Is the Fed prepared to become less aggressive, to rein in that aggressive rhetoric? So far, we're seeing it a little bit by some of the Fed speakers, but overall last week, what I heard was the Fed speakers, even some of the dovish ones, saying, hey, you know what? We're going to beat inflation, and we're going to do it and keep raising rates until it's done. So this is the tug of war that the market is looking at. In addition to all of this, the concerns over recession continue. And the question is always, what kind of recession? And that hasn't been figured out, and it won't be figured out. It has to be, was it just a growth recession, an earnings recession, or is it going to be something deeper? Fitch, the ratings agency, came out and said it sees a shorter recession. Right now, by the way, I'm seeing the market actually begin to sell off, not the Dow, but the rest of the market. I also want to mention oil right here. Oil prices are down, and the reason is it's being attributed to Chinese demand disappointing. China is the largest importer of oil. And there was a rumor that China was going to ease on their quarantine stay. So, we're going to shorten the quarantine for visitors. Suddenly, that morphed into that China is going to ease their zero COVID policy, and the economy is going to start booming again. Not so fast. President Xi was brought in for a third term. When I say brought in, he engineered it because he got rid of term limits. The term limits were actually just 2 terms. He would have been out, but he got rid of that, and he was brought in, anointed for a third term. All of the loyalists, Xi loyalists, are in the Politburo, and he is determined for a couple of things. One is to raise the technological profile for China. That is to say, make China a leader in technology. He's got a little bit of a problem, though, because the U.S. has been very, very determined to make sure they don't get any of our technology and semiconductors, right? Or any kind of technology that can be used in the military. President Biden is following what President Trump started. and that is we are not going to be helping the Chinese. We're going to do everything in our power to make sure they can't steal our technology. Nonetheless, she has made it clear that Taiwan is increasingly important and basically sent the message that Taiwan will be unified with mainland China. There was no ambiguity about what he said. Remember, Taiwan Semiconductor is there. Of course, the Chinese would, want to have control over that. This is going to be a major headline for those of you who are, focused on the semiconductors. Taiwan Semiconductor. Remember, they built a factory in Arizona, and also the U.S. government, in a bipartisan decision, actually have to put more money into building of our infrastructure of the semiconductor, the all-important semiconductor sector. So this is something that we are going to watch. There's been a major sell-off in Chinese equities. I want to go over that because one of the concerns is that regulation is going to be even tighter with Xi in complete and control of China. And if you noticed, a lot of the internet names, down, down, down. They want to make sure that the rebellion, and I say tiny rebellion, where folks are going out with banners in China and also in London, Chinese students in London doing it. But in China, it does not spread. And that is no more zero COVID, no more regulation, no more, communist control, on and on. This is not going to last. The Chinese authorities are going to clamp down, even if it means shutting down the internet if they have to do it. They will not allow any, especially now with Xi, with complete control. They are not going to allow any sort of issue whatsoever for rebellion. This is not going to happen. No demonstrations, no rebellion. And I think that's the reason you're seeing that sell-off in some of those internet names in China. But in terms of oil, keep in mind, despite the fact that the administration here in the U.S. wants to now release 15 million barrels from the Strategic Petroleum Reserve, oil prices have held up. The reason for that is that there's really tight supply globally, and demand is going to pick up, especially as the war with Ukraine really hinders the ability of Russia to export its oil. And the fact is, we're going to hear from a number of big energy companies over this week and next week. They will be asked, well, at what point do you actually make money? Do you need $100 a barrel of oil? The answer is no, they do not. Occidental Petroleum, I think I mentioned this on last week's call, they break even at about $40-45 a barrel. So again, we have to make sure we understand when we talk about energy, it's about natural gas, it is about companies, it's about refineries, it is about what they deliver to their shareholders. So all in all, this is an extremely important week for the market. We want to hear what Federal Reserve speakers have to say before they go into the blackout period. We want to see these inflation reports, particularly the PCE, at the end of the week. We want to hear from the Employment Cost Index, where are wages going. By the way, the Fed watches that ECE very closely. And overall, we want to see if the market can hold the rally that we enjoyed on Friday. It's important because the market is looking for any sign whatsoever that the Fed, well, forget the word pivot because that just means they stop, all right? But that they transition, that's the word I like, a transition to an easier, less aggressive pace. So let's pay attention to it, but keep your eye on the Treasury market, the 2-year, and also the 10-year for our guidance on the dollar, because the dollar weakens when those yields pull back. And we'll see the effect on the market, because a weaker dollar does help to ease financial conditions. A stronger dollar tightens financial conditions, and the dollar has been rising as those yields have also risen. So please don't hesitate to call me anytime or email me. I will get back to you in a heartbeat. But this is an important time for the market. It's an important time for the market to digest the earnings. And this week, boy, this is a really important week for those earnings. Keep your eye on the big tech names. Remember, 20% on a weighted basis for the S&P 500, just from a handful of those big tech names, Apple, Microsoft, Alphabet, and so on. Thank you very much. Have a very good week. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.